Hey everyone, my name's Emily Courtright, and this is my husband Adam Roberts. And we are here to talk to you today about the different note investing opportunities that we have going on currently with A&E Real Estate Group. Let me get my screen shared and we will go ahead and get started. Okay. Just a reminder that we are not tax, legal, or financial advisors, so please always check with your trusted advisors before making an investment. And I'm going to let Adam go into the basics of note investing.
All right. Well, thanks for joining us. We're going to talk a little bit about the fundamentals behind a mortgage note investment. Fundamentally, investing in notes is you becoming the bank. Just like we all pay our banks for our mortgage, you can purchase notes and become the bank. And what does that look like? Well, a mortgage note is very simply an agreement between the bank and a borrower for the borrowing of money. And so just like perhaps you have in your own mortgage, there's a terms of the agreement, such as a loan amount, interest rate, how long the loan is for, and this all boils down to a monthly payment. But at the end of the day, behind the curtain, a mortgage note is long-term cash flow secured by real estate. And that's what we are looking for when we invest in notes. Emily and I really like to diversify into note investments for these primary reasons. We can invest basically anywhere. We have notes all across the country in a variety of states and locations. And so it gives us a good location diversification. Because the terms of the mortgage note are known up front, this investment provides very predictable and dependable cash flow. The borrower knows how much they owe every month. And so when they're paying on time, I get cash flow into my bank account every single month. I know exactly what it's going to be. And really, at the end of the day, with market fluctuations, the economy, who's in the White House, etc., being the bank happens to be the position of lowest risk. At the end of the day, the terms of the agreement are agreed upon up front. The borrower owes the payment every month. And so the bank has the position of least risk in the entire investment. Here's a snapshot of our current portfolio of mortgage notes. You can see we have a variety of locations across the country, and we're continuing to add to this portfolio every single month.
One of the opportunities that we have with note investing is to partner with investors. And I want to show a visual of how that works. There, we can take a long-term note. Let's just say this is a 20-year note, and there are monthly payments coming in every single month for 20 years. And A&E, meaning Adam and Emily, we can buy this long-term note, and we have the ability to sell the front payments of the note. Now, these payments, if you think about an amortization schedule and the interest, how the interest is highest at the beginning of a loan, these are actually the most valuable part of the note because the interest payments are highest. So we have the ability to sell a portion of a note to an investor. This is also called in the industry a partial. So when we talk about selling a partial to an investor, we are talking about the investor buying a portion of a longer term note. Now, A&E, we are still fully vested in this note. We have a vested interest to make sure that this borrower pays on time and continues making their payment for the entire time, because once the payments to the investor end, the payments come back to us. So if we sold off 10 years, then the next payment after those 10 years were paid off would come back to A&E, and we would get the payments for the rest of the term. Now let's talk about our two investing options with A&E. We have two options. The first one that we haven't talked about yet is a simple promissory note. And the structure here, the interest return, is either a 6% if it's under $100,000 investment, or 7% if it's $100,000 or more. Now, this is paid out in quarterly interest-only payments. And we'll give you an example to break down the numbers. The term of this is 3 years. So it's a very defined, known term. And the minimum investment is $50,000. Now, the collateral is the business assets held by A&E. So it isn't necessarily tied to a specific single family home. It's tied to the assets that A&E owns as a whole. Now, the second option is the one that we mentioned on the previous slide. It is buying a partial. So you're buying a portion of a note, and the yield here, which we're going to talk a little bit more in the next slide, but is really the return. The return is 7%. It comes out to about usually over a 12% cash flow, and this is amortized payments on a monthly basis. So that's really one of the biggest difference from option 1 to option 2 is option 2, you get amortized payments, you get principal and interest coming back every month, and it's paid out monthly. Now, the term can vary. It can be anywhere from 4 years to 15 years. And we won't know until we buy the main note how much of the partial we can sell. The investment also varies. The smallest partial we've ever sold has been $16,000, but the biggest one could be over $100,000. And the collateral for this is a specific asset. So this agreement is tied to a specific asset or a specific single family home typically. Now let's talk about a quick difference between the cash flow versus the yield. And the cash flow is a straight, very simple calculation of the monthly payment times 12. So what you get over that year divided by the purchase price. So if you were to get $500 a month divided by times 12 months, and it was a $50,000 partial, it would be a 12% cash flow. Now, cash flow takes into account the principal and the interest coming back. So some of that $500 a month is your original $50,000 getting returned to you. Yield, on the other hand, which is typically 7%, only takes into account the interest portion of the payment. So the interest portion coming back is at a 7% return. And so I'm going to pass it back to Adam to go through the examples.
Let's walk through a few examples of both options so that we can fully understand how they work. So as Emily mentioned, option 1 is a simple promissory note to A&E. That means that Adam and Emily are essentially borrowing your money. Okay, so we have an example here of a $100,000 promissory note at a fixed interest of 7% for the 3-year term. Over those 3 years, the investor will make $21,000, which is very simply 7% annualized of $100,000 across that 3 years. And like Emily said, these are interest-only payments every quarter. So we retain your $100,000 principal and pay you a straight interest-only payment every quarter. And at the end of the term, we either renew or we return your principal. Looking at the partial option, we've got a couple examples to look at here. This specific home located in Arkansas, you can see the full note details there on the left and the remaining term that the borrower sees that lives in the home. And then, of course, the partial investment option there in the green box. So, for example, this particular note has a current loan balance of about $80,000. We purchased the full note for a remaining term of 332 months, which is almost 30 years. And we're selling this partial note to an investor for $47,000. Now, like Emily mentioned before, we are selling the front end payments, specifically the first 163 months of payments to the investor for that $47,000. And you can see the returns there at the bottom. It has a cash flow of 11% annually and a yield of 7%. So in essence, the investor is investing $47,000 for a $448 per month cash flow stream for 13 and a half years. Looking at a second example of a partial here where we have a mortgage note that we purchased, the full note, in Brady, Texas, which is in hill country of kind of central Texas. We purchased the full note, which was 200 months worth, and it had an $800 a month payment. We partnered with an investor and sold the front end payments, specifically 123 months worth, for $70,000. So this investor purchased about 10 years worth of $800 per month payments, and that was their cash flow stream. It was about a 13.7% cash flow annually and a 7% yield. Now you can see very quickly some of the due diligence that we do on the right-hand part of the slide. We look at the asset itself, the payment history for the borrower, and the title against the real estate to ensure that it doesn't have any encumbrances on it.
And let's use this example to talk about a reinvestment strategy. So we're going to use some of the numbers from this slide, specifically the $800 a month for 10 years. And when we talk about a reinvestment strategy, because one of the really unique things about the partial investment is the monthly return of capital with principal and interest. It's a really unique type of investment. So let's take one example, and let's say you reinvested that $800 on a monthly basis at a 5% return. Right now, that could look like a high yield savings, that could look like a treasury bill. But this first scenario we're looking at would simulate if you took that $800 a month and you put it directly into a high yield savings or directly into a treasury bill every month. Over the 10 years, you would have over $27,000 of additional gains that you would have made just from reinvesting that monthly cash flow. Now, let's say you don't want to have to manage that on a monthly basis, and you say, I just am interested in potentially reinvesting a lump sum. Well, the first point at the bottom is that half of your investment, $35,000, will have been returned to you within 3.5 years. 3.5 years in a 10-year investment, and already half of your investment's returned. So you, at that point, you could take it and you could reinvest in something at $35,000. But we're going to use an example at the 5-year mark. And at the 5-year mark, you've been returned $48,000. And so let's go to the next slide to look at those numbers. So after 60 months, this is a snapshot of the amortization table. You have received $48,000 back in both principal and interest. And let's say you took that $48,000 and just made another investment with it, whether it's a note, whether it's something else, a 7% return investment. And you kept that for the next 5 years. Just from reinvesting that one time, you would make an additional $19,000 of gains on top of all the gains that you made from the partial. So the reinvestment strategy is really important to consider because of how unique it is to be able to get your principal and interest back so quickly. Now, who are these options for? The promissory note is really for the person who's looking for a shorter term commitment, and shorter term meaning 3 years, that still offers a predictable cash flow stream. Option 2 is somebody who wants to lock in a strong yield for the long term. You might be able to get 5.5% in a high yield savings account today, but in 5 and 10 years from now, we don't know what those savings accounts are going to look like. So this locks in a 7% return for 5, 10, up to 15 years in that partial term. And because of the monthly principal and interest coming back and the ability to reinvest that funds, it has the highest potential return. Now, both of these options are great for people who have self-directed retirement accounts. So if you want to use self-directed retirement funds, that is absolutely an option.
Looking at how the process works investing with A&E, it truly is an active versus passive relationship. Adam and Emily, we source the notes, we review all of the collateral files and perform due diligence on the mortgage note. We verify the valuation of the asset. And then, of course, we oversee the closing and work through the transaction on the front end. Additionally, as the years go on, we actively manage the asset to ensure that the borrower stays on time with their payments. And if anything happens with the borrower's payments, like they get behind or they have a hardship, we move in and work with the servicer to find the best possible solution for all parties. Our investor partners, the folks who partner with us on partials and do promissory notes, they simply enjoy a monthly cash flow, a dependable, predictable cash flow that is known up front, and as Emily mentioned, by locking in that long-term strong yield. Well, thanks for taking some time to hear our presentation about partnering with A&E on mortgage note investments. We do have a investing interest form here on the QR code. So please feel free to scan this and fill it out if you are interested in getting involved and want to learn more about mortgage note investing. And of course, we can always be reached at these phone numbers and emails here on the screen. We really appreciate you spending some time with us. Feel free to get in touch with us, and we look forward to working with each and every one of you.
Thank you.